And when people are saying real estate's terrible, it's like catching a falling knife. I would never buy that crap. It's a great time to buy.
So we're getting closer.
We're getting closer. I mean, people are starting to say like, oh, I don't know about that. That means we're getting a little bit closer, but we're not all the way there yet.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Welcome back to The Path to Wealth. I'm your host, Hannes Henschel, and today we're delighted to introduce Brian Burke, the visionary CEO of Praxis Capital, a leading real estate private equity firm with a 30-year career. Brian acquired over $800 million worth of real estate, including over 3,000 multifamily units and 700 homes. An author and sought-after speaker, he shares invaluable insights at real estate forums and conferences nationwide. Thank you so much for taking time, Brian.
Yeah, it's really a pleasure to be here. Thanks for having me.
Yeah, 100%. So we already spoke a little bit about why did you originally write the book about what it takes in terms of passive real estate investment in syndications?
Yeah, I wrote it for a couple of reasons. A friend of mine that I worked with when I was 16 years old had invested in a passive real estate syndication, invested her entire life savings in this deal, and turned out that the sponsor was a crook. He was a convicted felon with a history of wire fraud, among other crimes, and the investment completely tanked, and he raided the corporate coffers and basically ran off with all the money. And my friend lost her entire life savings. This sponsor is in prison, but that's no consolation to my friend who, instead of being set for life in retirement, is instead driving for a rideshare service just to put food on the table. So that was one reason why I wrote this book, is if I could just do one thing to help prevent that from happening to anyone, friend of mine or otherwise, then it'd be well worth the time.
Yeah, 100%. It's one of those projects where, like, if I can just touch one more life, it's worth my time.
Yeah, it is, and I think it's helped more than one person, thankfully. Yeah. I've had a number of people that have approached me at conferences and said that it really changed their perspective on passive investing. Interestingly enough, I've had a lot of real estate sponsors who this book wasn't written for real estate sponsors. In fact, I kind of was a little bit of afraid when I wrote the book that real estate sponsors would have a bone to pick with me for calling them out on exposing all the secrets of the industry. But I've had a lot of real estate sponsors come to me and say that they recommend this book to all of their passive investors that invest in their deals. And in fact, I even talked to one that said he buys the book. He buys a copy of the book for every one of his investors and hands them out. And so I thought that was really interesting. So I think it's touched a lot of lives, and it's a lot of copies are out there in circulation. So I'm very pleased and proud that I could help a few people here and there in their journey.
Yeah, and I think that's the more rewarding part of what we're doing beyond earning money and making money and structuring deals. It's when we get to touch other people's life and help them navigate their own journey.
Yeah, I mean, you certainly don't earn a lot of money as an author, especially when you have one book out there. It's certainly not going to allow me to retire anytime soon. So that wasn't even part of the equation when I wrote it. But it's really cool to be able to do that. There's a side benefit though. We sponsor passive investments ourselves. We buy apartment complexes and we pay for those apartment complexes with money we raise from passive investors. And the book being out there, it's surprising to me how many of our passive investors by now have read this book. And we get such better questions now. And so it feels like the investors that are investing with us are better educated, better prepared, have a better understanding of how these investments work. And that's a side benefit to us in the business, in the industry, because we don't have to spend as much time educating people on the basics because they already came in with that knowledge. So it's a cool side benefit.
Yeah. And I think it also elevates the industry. Like, as you said, if other sponsors give out the book and if their passive investors become more educated, you just have an overall more sophisticated investors base that is part of the deal, which in turn pressures sponsors to put better deal structures and better deals on the table, which kind of keeps everybody in check to do good work.
Yeah, they have to step up their game. And certainly I can't be one to take credit for industry transformation. But to the effect that it actually causes some sponsors to step up their game, whether it's because they want to or because they have to, because their investors are better informed, I think that helps everyone in the business, and when we collectively as sponsors do a really good job, we all benefit from that, because anybody knows if one sponsor out there screws up, loses someone's money, is a crook, takes off with it, whatever, the legitimate or honest or hardworking or competent, whatever category you want to put them in, those sponsors will always be asking questions about, well, how are you different than this guy, right? Or how do I know I'm not going to lose my money with you like I did with him? So that kind of stuff, it helps us all.
Yeah. So another question, did your friend stop investing after that incident, or maybe he got more educated, got some guidance, and got back into investment?
No, she has nothing left to invest. So
burned for life.
She lost her entire life savings and had no ability to recover from it. So she's out of the game. Yeah, one mistake can permanently take you out of the game, and it can also ruin your retirement. And I've just seen way too many cases of this. I mean, there's news articles out there from time to time about somebody that bilked investors out of X number of dollars, and it usually has 2 commas. There's a lot of that happens out there, and this concept of passive investing, it's a very legitimate path to alternative investing. It's a legitimate augmentation of your retail investment strategy, but it's also anything but passive when you're in the phase of locating and doing due diligence on sponsors that you're going to invest with. There's a very active component to sponsor selection and deal selection. You don't get passive until after that's done. After you've picked who you're going to invest with, you put your money in the deal, now it becomes passive, and people want to push the passive button a little too soon. You've got to be very active in that selection process.
Yeah. So what are some of the better questions you want passive investors to really push in that due diligence phase so that they find the right kind of sponsors and deals?
Well, the main question is going to circle around the sponsor's experience and track record. I mean, this may sound kind of cliche, but it's very, very relevant. How long somebody's been doing it, what kind of results they've produced. And I think even more importantly, when the market wasn't going in their favor, how did they do, or what did they do, or how did they react to the adverse circumstances that they were faced with? Because I think that's really where the rubber meets the road. I mean, anybody can, well, not anybody, but a lot of people can go out and sponsor a passive real estate investment and gather up people to put money into a kitty and go out and go buy some real estate. But to be able to survive an adverse market cycle, to solve problems, to deal with challenges, all those things require skill. And I equate it to flying an airplane, because that's my only real hobby. If I'm not doing real estate, it's flying airplanes. It's really easy to fly an airplane on a sunny day. I was a 16-year-old kid. I took my first flying lesson, and I learned within 10 minutes how to control an airplane on a sunny day. But put that same person in that same airplane in a storm, and it's very likely they won't survive. And this is the same kind of thing here with real estate sponsorship. So you want to know what their experience looks like. If they've been around a long time, they're doing something right, and that's a real strong indicator that you might have somebody good.
Yeah, and I think that's especially important in a market like right now. Right now you don't want to bet on somebody who's just kind of learning the ropes. You want somebody who's really experienced and knows how to create efficiencies within the investment vehicle.
Yeah, that's right. And then, of course, you have the flip side of that, where newer sponsors are like, hey, I don't have that kind of experience. How am I supposed to get the experience? How do I get into the business right now? You didn't start with all this experience. So how did you get to where you were? So there is a little bit of that chicken and the egg thing, right? That happens. But, people just
it's just same in the airplane, right? You have a co-pilot for a reason. It's somebody with less experience.
That's right.
that you take along, and they kind of earn their ranks, and eventually they're the pilot in command.
You nail it. You nailed it. Yeah, you're going to have a flight instructor that's going to teach you how to do it. And then after you have a flight instructor, you're going to do recurrent training. And after that, if you're getting into more complex airplanes, you're going to have mentor pilots that will, kind of show you how that works. And if you're flying for the airlines, you're going to have a captain that's going to be in charge and is going to be monitoring everything you do. You can have somebody with experience on your team to augment your lack of experience. But, a passive investor needs to understand what the experience and skill level is of the person that's responsible for overseeing their money. And if they don't have that extensive experience, who on their team is and how committed is that person? Are they just kind of there in the background just as a name only to be on the website with a picture?
Yeah.
Or are they actually really involved in making decisions?
Yeah, especially when stuff hits the fan. Are they actually available? Do they have the bandwidth and the interest to actually be involved in turning that ship around?
Yeah, or preventing it from having to need to turn around in the first place. Yeah. There's a lot that goes into this, and the experience is great, judgment is great, but a lot of some of it also comes down to character. If I don't care how good the deal is or how long somebody's been doing something, if they have poor moral character, it's probably going to end up in disaster. Now, generally speaking, people with poor moral character don't last very long in business. So, these are those kind of here today, gone tomorrow kind of people, and that's one of the things you're trying to avoid as a passive investor, is to sort out the who's who.
Yeah. So, given that you've been in the industry for 3 decades, where do you currently see opportunity, or where is your firm kind of trying to find yield for the investors?
Oh man, I'm finding opportunity on the golf course. I'm trying to improve my golf game. That's probably been the way I've spent most of my time, because there's no opportunity out there right now in the real estate space that I can see. Not right now. I mean, maybe we will. That might change next week or next month or next year, but right now I'm not seeing a lot of opportunity in that regard. What we are doing, the only thing that we're actively doing right now, I had about 4,000 multifamily units. I sold 3/4 of those in 2021 and 2022. So what I think was the peak of the market, I basically exited out of most everything we have, just save for some nice Class A properties. So I think I saw the top of the market coming and got out at the right time. Now I'm waiting to see if I can see the bottom again. I was able to catch it last time it came up, hoping I can catch it again this time. But in the meantime, we're investing in real estate debt. We have a debt fund that we've raised money for, and we're just out buying notes secured by real estate, which to me gives me a couple things that real estate doesn't give. First of all, when I buy a real estate note, I'm getting cash flow day one, not year two. It's day one. So that's different than what you'll see in buying the actual asset right now. The other thing is that somebody else is in first loss position. Whoever that owner is and or their investors have put up a down payment, money to renovate, whatever that might be. If that property goes down in value and they have to sell at a loss, it's their loss long before it ever gets to be our loss. And in a market like this, that's a really feel-good place to be, is to have somebody else in first loss position. And so that's really the only thing we're doing actively right now.
Yeah, that's interesting. I didn't expect the answer. It's like, I'm on the golf course. But it's my time wisely spent, no?
Well, I always say, like, there's a time to buy, there's a time to sell, and there's a time to play golf or sit on the beach or take a vacation or whatever it is that you like to do that isn't either buying or selling. Because right now is not a great time to buy. It's also not a great time to sell. 2 years ago was a terrible time to buy, but it was a great time to sell. 10 years ago, it was a great time to buy and a horrible time to sell. But right now, it's not a good time to do either. So we're not doing either.
Yeah, but it also takes that perspective, which comes with the experience that you have. You've been through cycles. You can look at it differently. Like some of like the first cycle you speak about, the bottom of that, I wasn't even part of the game. It's nothing that I'm aware of unless I study the past, which is what I'm trying to do. Obviously, I'm also kind of trying to see patterns and not freaking out about a moment to moment picture, but like, okay, zooming out and understanding the larger market cycles.
Yeah, I think that's right. And, it's there's not one thing that actually tells you much about the market. It's a confluence of all sorts of different factors. And, I'm fortunate that I've seen this movie before. I kind of know how it plays out. The funny thing, each time it's just a little bit different, right? I mean, like there's rides at Disneyland where it's the same ride every time, but each time there's a little modification to what the characters are doing, or something in the background is always different, right? So it's never exactly the same. And this is kind of the same kind of thing where, it's the same ride, but there's always nuances. Like the 2000.com collapse, it didn't really impact real estate that much. It was an economic recession. There were some job losses. There was a lot of stock losses, but real estate kind of didn't really feel it. And then 05, 6, 7, 8, 9 comes along, and real estate gets annihilated because real estate was the cause of the whole thing. And, whatever spark lights the flame is where the you get the deepest char. So that was a mess in real estate. And now this time around, it wasn't caused by real estate. It was caused by inflation and kind of all kinds of other stuff going on, pandemics. And, you can never make this stuff up, right? Different stuff happens and it's going to affect things differently. So how it plays out in real estate is going to be a little bit different. But one thing always seems to be the same. And that is when people are irrationally over exuberant about buying real estate, it's time to get the hell out. And when people are saying real estate's terrible, it's like catching a falling knife. I would never buy that crap. It's a great time to buy. And
so we're getting closer.
We're getting closer. I mean, people are starting to say like, oh, I don't know about that. That means we're getting a little bit closer, but we're not all the way there yet.
Yeah. So for you, given all the experience you have, what metrics are you waiting to change so that are you waiting for sellers to kind of price in the adjustments that buyers are expecting? Are you waiting for an interest change? Or what is the metric that will move the needle for you to move from like a passive position to go back into the deals?
Well, I think sellers getting their back against the wall would really make a big difference. Because here's the problem that we're seeing right now. From an operational perspective, most sectors of income-producing real estate, such as apartments, self-storage, industrial, medical, they're operationally doing just fine. They're collecting rents. You got rent increases. Revenue is good. Yeah, there's some problems with expenses because insurance costs are going up and so on. But operationally, they're doing pretty well. The problem, except for office is a total disaster. But the problem is that despite those operational successes, there's little or nothing to show for it. So the investors aren't getting rewarded. The owners aren't getting rewarded because values have fallen as a result of decompressing cap rates, which resulted from a decline in rent and revenue growth, coupled with increases in expenses and interest rates. And you take that and you kind of, mix that in with a dash of fear and, a
uncertainty.
A couple ounces of uncertainty and all this stuff, and you mix it all together and you get this recipe for this weird illness that nobody really is describing very well. But the way I see it is it's just simply a bid-ask spread. You got sellers that are thinking like, or owners who are thinking like, I don't need to sell. This thing's operating just fine. Yeah, I'm not getting the cash flow I want, but we're hitting our income targets and we got enough reserves to hold on. If their financing structure is conservative enough, they can wait this whole thing out. And then on the flip side, you've got buyers saying like, well, look, borrowing costs are through the roof and, and all the expenses are going up. So I can't pay anywhere near the price you want. And sellers are like, well, I'm not discounting the price because I'm doing just fine. So you're in this, there's no, who's going to blink first? Well, in my opinion, the one who blinks first is going to be the one that has their back against the wall. Most buyers don't have their back against the wall because they don't have money just sitting around burning a hole in their pocket. Some do, and that's been what's actually been keeping even the small amount of transaction velocity we've seen even happen. But sellers don't have their back against the wall either, because operationally they're all right. But there's a lot of sellers out there, or I should say a lot of owners out there who bought maybe in the last 2 or 3 years that got some really aggressive financing terms and with short maturities who are going to be coming up to pay the piper day. And when that day gets here, they got to figure out how they're going to navigate through that. And they're going to have to either come up with money to do a cash-in refinance. There's a new one. Haven't had to do those in a while. Or sell, but buyers want a lower price, so they'll have to sell at a lower price. Or find some other way to survive by convincing their lender to give them more time, which may or may not happen. So there's going to be motivated sellers at some point, and that's gonna help.
That's what you're waiting for.
That's what I'm waiting for. I'm waiting for motivated sellers coupled with disgusted buyers. If I could find those two things, we saw that a lot of that stuff in 9, 10, and 11, but I haven't really seen it since then.
So anybody who's motivated, reach out to Brian on the golf course. No, I'm just kidding. It's
right.
It's like you won't find him at the office. You actually have to go to the golf course.
This is true. Actually, it's more true than you'd think.
So in terms of overall timing, if you compare to what you've seen before, how long do you think you have to be on the sidelines until that actually transpires? In terms of the financing that you mentioned, somebody who's been on those aggressive terms maybe 2-3 years ago, that should transpire somewhere within the next 12 to 24 months.
Yeah, I just saw a chart, I don't know, yesterday or maybe it was today or yesterday or the day before, showing loan maturities for like the next 2 years. And there's a lot of loan maturities that are happening between now and the end of this year. Surprisingly, a large dollar volume of loan maturities between now and the end of the year. And then a pretty significant volume of maturities throughout next year and even the subsequent year. So I think this is going to be a while. I mean, I feel like it's going to take a little bit of time for all this stuff to work out. Let's say you got a loan maturity at the end of this year. That doesn't mean like there's going to be deals in October. They're going to get to the loan maturity date. They're going to be negotiating with the lender, trying to figure out what to do. Maybe they get an extra couple months or 6 months or, whatever. And then they can't figure it out. So the lender starts foreclosure. And then it's 6 more months after that. And they're finally, putting the hammer down and saying, we're taking this to auction or, we're, whatever. So it takes a while. It doesn't mean like, oh, loan matured yesterday, today there's a distressed seller. It's not quite that fast. So it's going to take some time. There's a lot of loans that are out there that are going to go through this. That's going to take some time. I don't think interest rates are going anywhere for a while. I mean, maybe up. I don't know. It's the way it seems like all they ever do is go up. We're at a 22-year high as of yesterday, and we're recording this at the end of July. So they just did another increase on the Fed funds rate. So we're seeing, record high interest rates for the last couple decades. And I don't think that's going to change, not to a significant amount anytime soon. I mean, we may be seeing high rates for, years. So it's no way of really knowing how long this is going to last. It's too early to call.
Yeah. This kind of reminds me of the theme that I've seen at many of the multifamily real estate conferences, like survive till 2025, and then from there everybody can kind of see how they're taking it from there, where interest rates move. But it's like really in that particular moment right now, it's like just make sure you got your deal structured in such a way you got enough capital to get to that point, and then see how you can make sense of it for the future.
Well, if you look at the failures in the last Great Recession, the deals that ran into the biggest problems were the ones that had high levels of debt, shorter maturities, high loan to value ratios, low debt coverage ratios. Those were the things that really got people in a pinch, especially if they had low cash reserves. You can survive these cycles if your debt is low enough, your debt service coverage is broad enough, and you have some cash in the bank. That's really going to be what sets apart the people that make it through and those who don't make it through. So, people ask me all the time, like, how do I know if this deal is going to survive, or will it survive? And it's like, that was decided when the deal got started, because they either set themselves up for success or they set themselves up for failure. And it's almost too late now to go back on that, whatever, when the book's already written.
Yeah. Yeah, it's something you said earlier, somebody who was over motivated 2 years ago, too aggressive on the terms, didn't find the right pricing, bought top of the market. They certainly have a lot more pressure on their books right now than somebody who was like, okay, this is getting a bit too hot. Or like yourself, somebody who was actually like, this is way too hot. I'm selling.
Yeah, and not only did we do that, but anything we were buying using conservative financing, like 60 to 65% leverage, 10-year maturities. You just got to give yourself time. That's what's most important. Is you need a wide spread for cash flow, and you need a lot of time, because that will get you through and raise a lot of reserves. So we've tried to do all that on our what portfolio we have left. We've tried to put ourselves in that position to the extent possible, because that's going to be really helps us get through to the other side of all this.
Where did this understanding originally come from you? And this is something, everything you just said is something I hear from the best syndicators in my network. It's like, to position yourself like that. Did that come to hard lessons you had to learn throughout your career? Is it something you naturally kind of soaked up by going through the cycles?
No, I don't know that any of us really learned anything the easy way. We always learn stuff the hard way, because the only time you're really paying attention is when the shit hits the fan. That's when you're really paying attention, right? When everything's going right, people don't learn really a lot from, you don't learn anything from deals that go right. You learn everything from deals that go wrong. And, having survived the Great Recession and all that, I was fortunate, knock on wood, that in the 34 years I've been doing this, I've never lost a dime of investor principal, but I've lost a hell of a lot of my own money. And every time it's always been because I ventured outside of my core competency, or didn't put the right capital structure in place from the beginning. And, we just learned, through the school of hard knocks that, excessive leverage and short-term maturities are a really uncomfortable place to be, and I never want to be there again.
Yeah.
So I don't go there anymore.
Yeah, I feel like over time we learn to value sleeping well. Like that's how I look at it now, Initially, it's about, getting stuff done, getting certain valuations set, being aggressive. But then I realized sleeping well is so much more worthwhile.
Yeah, it's so true. I mean, it's kind of like, it's a weird thing that happens in the career path of any, successful real estate investor, is early in your career path, especially if you started like I did, where you started with nothing. You have to be aggressive and you have to take excessive risk in order to kind of grow into what's required to be successful at a higher level. It's almost like a rite of passage that you have to go through. Now, as a passive investor, it's like, do you want them to be doing that with your dollar and getting that experience with your dollar? That's why I advocate, experience is really key. But, that's still something that, early in my career, I did it. I had to take big risks and, really outsized risks. And now I wouldn't do that again. I mean, I say, well, I'm too old to make it back, but that's not the only reason. I mean, the other reason is like you said, I'd rather get good sleep at night and not have to worry about it. Having those kinds of like, oh shit moments are not fun. And I don't like to go through them, and don't really want to again.
Yeah, I can relate to that 100%. So just kind of reflecting on your own career, 34 years, what are some of the biggest maybe punches you had to digest and reflect on, and what did you learn from them?
One of the toughest punches I took was right after Bear Stearns and Lehman Brothers collapsed in 2009. And I had an apartment complex that I had too much debt on, because I bought it basically with 100% financing, and it was a foreclosure deal where the previous owner couldn't figure out how to make it work. So he got foreclosed. And then I bought it from the lender, and the lender basically financed the whole thing. That should have been a clue. They wanted to get rid of it that badly. That they'd basically give it to me. And I thought, well, this is great. This is what all the books say you're supposed to do. You're supposed to buy with no money down or use other people's money. But there's no margin for error. And, after that economic calamity and our tenants started losing jobs, I used to joke that I said, half the units are empty and the other half aren't paying. And while that wasn't entirely true, it was close. And, the property generated just enough income to cover the expenses, but no money left for debt service. And so it's like I have to decide, do I hand the keys back to the bank and the investors take 100% loss? How am I going to get out of this situation? And, at first I thought, well, this will probably be over with in a month or two. So I'm just going to make up the difference of what, it takes to pay the mortgage payment this month. The first month is a couple grand, then it was like a couple more grand, then a couple more grand. And then finally the property was doing so poorly, it couldn't pay any of the mortgage. So I did the whole thing. I was paying $15,000 a month out of my own pocket just to pay for the mortgage on this property. And it was extraordinarily painful, but it was also the right thing to do. And ultimately I wouldn't be where I am right now if I hadn't done that, because a foreclosure on my track record certainly wouldn't have looked good. It would have been a career ender. But instead, my investors didn't lose a dime. And in fact, we sold that property several years later, made a nice profit on it, nice enough for I got all that money back that I loaned interest free to keep the mortgage afloat. And my investors got all their money back, plus a small return, which was a big win to get any return at all. Yeah. And, when you go through something like that, you're like, I never want to do that again. So it completely changes your perspective on how you finance projects, how you underwrite deals, how you think about economic vacancy, how you think about classes of property and how they perform, and neighborhoods where you'd want to invest versus where you don't. I mean, the list goes on and on. It was an absolute game changer for me. It was the best thing that happened to me in my career, but it was the worst thing that ever happened to me in my career, if that makes any sense at all.
It makes perfect sense. I have something like that. What to me felt like in that particular moment, it was a really bad partnership, and it sucked, and we lost so much money in it, only our own money. But I was like, this is just so painful. But now years later, I can still kind of draw from that experience. I'm like, no, this is not the direction we're moving. This is not the kind of partners we want. This is not how we structure deals. This is not what we're doing. And I think over lifetime, the loss will be minuscule that I personally took on that compared to the learning that will benefit me in so many other ways. So, but do I ever want to go through that again? No.
Yeah, I'm with you. I don't either. Once is enough for me. And, and now I'm seeing some of the same things happening out there in the world. And, I'm glad I'm not in that position this time around, because it would just be, here we go again, and that would not be fun.
So if you were given the opportunity to talk to young Brian starting out in real estate, what would be like the 3 key lessons you would give him?
This is similar to the question I get a lot. What would you do differently too? And I always say I would have done nothing differently. So even the painful, undesirable things that happened all played a role in getting me where I am today. And if I take any of those things out, it could change the whole, like the Back to the Future movie, right? It's like, well, if you go back to the future and you change one thing, it could change the whole course of the future, right? You might not even be born. And so this is kind of the same thing. I look at it that way. Like, really wouldn't change a thing. So I think my advice would be, you're going to go through some stuff. You're going to be tested. You're going to have some unpleasant times. Do the right thing and you'll get through it, and you'll be much better for it. And so you got to just roll with it. That probably would be my number one piece of advice to younger self, because when I was going through it, it's like, why did I get myself in this situation? What could I have done to have avoided it? And all that stuff. And while that's good because you're thinking that way, that's growth. You wouldn't be thinking that way if you weren't going through it, oddly enough.
Yeah. But I think one of the things that you touched up on is like, do the right thing regardless. Like, there's pressure. And as you said, like, you chose to make those payments out of your own pocket, not taking interest on it either. And like, this is the kind of stuff where your investors are like, okay, that's the kind of person I want to go to battle with.
Oh, you'd be surprised how often we tell that story to new investors that are researching whether they want to invest with us, and it solidifies their investment decision that they're in the right place. You would think like, you don't really want to talk about the failures. You don't want to talk about the difficult or the challenges and all that stuff. And I think a lot of sponsors mistakenly avoid having that conversation with investors. But you'd be surprised how receptive they are to hearing that story, and how it gets the message across just as you just articulated it.
Yeah, as you said, you want to have a pilot that's been in the storm and managed through the storm and got the plane landed again. You don't want the pilot that only has it's all been blue sky so far. We're doing just fine.
Yeah, that's, kind of goes to one of the other things that I preach in the book to look for is, you invest with people who have landed the plane. How many people are out there raising money for investments that have never sold a deal? They've never actually bought, successfully operated, sold, made a profit, and returned capital and profits to the investor. That's like a pilot that learned to take off but didn't learn to land, right? and do you really want to be flying in that plane? That's you led right into another thing to look for. You want to see somebody that's actually been through the whole thing and bought, operated, and sold, and done so through market cycles. So you have full cycle experience. That means you bought, operated, and sold, and you have market cycle experience, which means that you've been through challenging market cycles and got your way through it. So those two things are really big.
Yeah, I agree. I definitely, I'm flying back to Europe tomorrow. I want to sit in a plane where the guy knows how to land it.
Yeah, I think that's probably a good idea if you really want to make it all the way there. And it also has flown through a storm or two. Now, fortunately, there's licensing standards, right? So when you get on that plane, you have a expectation that the guys or gals in the cockpit have gone through extensive training. They've passed an enormous number of tests. They've gone through interview processes. They've gone through flight checks. They've gone through chief pilot proficiency tests. They've gone through all these different things. And now they're bringing you somewhere. But yet you'll hand over $100,000 to somebody and there's zero licensing requirement. There's no test. There's nothing. It's just they said, I've got this real estate deal. Will you give me money for it? So that means you've basically got to give them the exam as the passive investor and make sure that they pass. Otherwise, don't get on board. Just wait for the next flight.
Yeah, 100%. I like that. Well, Brian, one of my favorite questions that I always like to put in at the end is, what do you consider a life well lived?
Life well lived is one where you have gone out and done everything you wanted to do with your life, and not just in business. I like to travel, so that's important to me. I've been married for 34 years. That's important to me. I think a nice, well-rounded life means that you've been able to do all those things while at the same time making a difference in the world and making other people's lives better in some way. If you can do all of those things, that's one hell of a life. Yeah, I agree. Well, Brian, where can people connect with you beyond the golf course and actually read you online or your firm? Right. Yeah. Gotta be careful where you're looking for me out there. I'd go to our company website for Praxis Capital. The company's Praxis Capital. It's praxcap.com. It's praxcap.com. You can also follow me on Instagram at Investor Brian Burke. And you can check out the book. It's called The Hands-Off Investor. You can get it on Amazon. You can get it at from the publisher at biggerpockets.com/syndication book. If you get it there, you also get some bonus content, which is pretty cool. So you could check that out. And you can also find me sometimes on biggerpockets.com forums answering questions in the question and answer forum. You just never know. Awesome. I'll also make sure to add all of those to the show notes. Brian, thank you so much for taking the time. Yeah, thanks for having me here. Really appreciate it. Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.